Welcome back.
It is almost the end of the year. It's been a long year.
Yeah. Merry Christmas.
Merry Christmas. Happy Hanukkah. It's not too many Hanukkahers in Utah.
Around here.
But before the big ball drops on New Year's, we're going to go over 5 tips and tricks that as a property manager or self-owning landlord, you should be looking into before the year ends.
Yep. So cleaning up your books is going to be your first priority. You can do this in January. I have done it before I was doing this full time. When I owned rental properties, I would do a crunch right before tax season of going through all of my expenses. So whatever, if you're using a credit card, all your Home Depot receipts, and looking at all of your utility accounts, it takes forever if you do it this way. If you do everything all at once. Or you can get a property management software, or you can hire us. And we would keep track of everything for you throughout the year. So all of your expenses on repairs, maintenance, utilities, anything that you as an owner would take care of and count against your income, your rental income throughout the year. Getting ready to do that. So Q4 is just making sure all that's right. If you're not reconciling your accounts monthly, at least, then this is a good time to catch up and do all of those things too. So we reconcile monthly, do what's called the triple tie out. So making sure all of our bank statements and all of our expenses in our software is accurate, and we do a reconciliation monthly across all of our accounts. So this keeps books clean, and it helps reduce your liabilities, tax liabilities.
Mm-hmm. Yeah, and that all ties into the second one, getting your deductions in order. Like you said, doing it monthly saves you so much time and a lot of money if you're cramming it in December and January, right?
You're for sure going to miss stuff.
You're going to miss stuff, lots of things. I mean, things you can deduct as well. You can go miles to and from your properties, key copies, damages, air filters if you're nice in providing them to your tenants. Anything basically related to that property can be used as a deduction. And if you're going to do it by memory or try to go through your bank statements at the end of the year in December, it's going to take you a lot of time. You're going to miss things. You're going to get lazy. You're going to overlook some important stuff, and it's just going to cost you money at the end of the day.
Yeah, you're going to want to expense your time as well. So you've got your miles, but you also have your time. So if you're working on a property, say you've hired a plumber, you can obviously expense that. But if you are aligning the plumber to go over and do the work, or you're doing the work yourself, what time are you expensing for yourself against your property for that? So something to keep in mind.
Yeah.
The next thing is to evaluate your structure for how you're holding your property. So we'd recommend that everyone would hold their property in an LLC. So you can just have it in your individual name as the property owner. We wouldn't recommend that for liability reasons. So, for example, and we're not attorneys, we're not here to give advice that way, but if, say, a tenant were to trip on your stairs and break their face or whatever, they have to go get surgery, and they could go ahead and sue you individually as the property owner because of that. So not only would it affect your property, but they can go after all of your personal assets. If it was an LLC, a limited liability company, and it's holding specifically your property or maybe a small portfolio of properties, I wouldn't say more than 10 properties per LLC, then they can just go after that particular LLC is all. And hopefully you have insurance as well for that. E&O or general liability insurance is important on top of your property insurance for these types of things, but making sure if your property does have insurance to cover renters, that it has the right insurance to be able to cover these types of things. So
yeah, that goes for being a real estate agent as well. Clients can sue you for anything. If they get a complaint or anything, they can come after your whole lifestyle rather than just if you're operating your business out of an LLC, it only covers you for limited liability.
Yep. Next thing is 1031 exchanges. So this obviously isn't going to affect every year, but if you're considering selling a property and wanting to kick the can down the road for your taxes, the way to do that is through a 1031 exchange. There's other methods, other paths to do it as well. The most common one is the 1031 exchange, which allows you to defer your tax liability into your next property. So you're moving all of your equity from property A to property B. And there's things, we'll get more into the details of that later, but you have to be buying a property that is like kind, and it has to be a greater value. If not, there will be a clawback for any additional portion if you're buying a property that is less than. It's what's called boot, the leftover funds that you would be taxed on, whatever your tax bracket is.
Mm-hmm. We've had a few owners 1031 exchange properties from another state into Utah now, and that's how they've been able to survive this market, because they're not worried about their mortgage or their margins having to make price reductions on asking rent. And so 1031 exchange is a great way to be able to build a rental portfolio.
Yep, exactly. So in a lot of cases, people will be moving from like a condo. They buy a condo as a rental property first and maybe upgrade that to a single family property or a small multifamily property. And then they'll be graduating those into larger and larger properties, bigger portfolios as you build equity over time.
Oh, yeah. And last but not least, the one that I think everybody gets into real estate for is the cost segregation.
Yep.
Yeah, I mean, I guess for those who don't fully understand cost segregation, I mean, what's the benefit of it?
Yeah, so I would say this is the reason that it's not super common knowledge, I would say, in the general public for what it does or how it can benefit you. A cost segregation is simply a study. It's a study of your real property, so your property that's actually built on land. So you can't run a cost segregation on your primary residence or on land. So this is strictly for investment properties only. But if you do have an investment property, you can run a cost segregation study, and it will analyze the total value of your property, of your real property on the land. And then it will take a look at the age of your appliances and all those things, and then give you a depreciation schedule. So typically a property is depreciated over, I'm going to get this wrong, it's going to be 26 or 27 and a half years normally. So if you want to increase that, you have to do what's called a bonus depreciation. And how you do that is by running a cost segregation study. And then you could bonus depreciate the property, so accelerate the depreciation in a shorter time window. So it's going to be, in most cases, depending on what your CPA suggests, within a 5-year time window of doing the bulk up front and then just accelerating that over the next couple of years. So I would say, as a recommendation, if in the greatest income years of your life, that as a strategy to add real estate to your investment portfolio for this particular reason, just because it's going to be counteracting your income. So say you're a baller and you make $500,000 a year and you buy a $1 million asset as an investment, maybe a multifamily property, then you could bonus depreciation likely between $300,000 to $400,000. So counteract $300,000 to $400,000 of your income from buying this real asset. And you're not going to have to spend that much. Your down payment is likely going to be 20 to 30%, maybe a little bit more depending on where you need to be at cash flow wise. But yeah, one of the best strategies in the investment world. It's real estate's not a crazy growth appreciation asset. It's a leveraged asset, so you're going to be making more on the money that you do put in. And you'll be able to have your renters cover the costs of that, which is great. So it's an awesome investment that way. But the real thing is from doing the cost seg.
Oh yeah. Well, there you have it.
Yeah.
That's ways that you can get your end of the year investor tactics. So.
Yep. Catch you next time.
Thanks for tuning in. This has been Utah Rental Property Insider.
Yes. Nice. I kind of said too much on cost seg, maybe?
No, that was perfect.
Okay.
That gave